Across the 48 hours starting April 4th, 2025, global equity markets lost $6.6 trillion. The Dow Jones Industrial Average fell 4,000 points in its worst two-day period on record. The sell-off began immediately after President Donald Trump invoked emergency powers to launch Liberation Day, the centerpiece of a new, aggressive protectionist agenda. The administration imposed a 10% baseline tariff on nearly every import to the United States. For major trading partners, the rates were even higher, 20% for the European Union and 245% for China. Markets reacted with immediate panic because these tariffs act as a massive tax on supply chains. When import costs spike, corporate profit margins are crushed, leading investors to dump stocks as fast as possible. This crash was the predictable result of a global trade war. But while the stock market was doing exactly what economists expected, a different, more dangerous crisis was unfolding in the one place that is supposed to be safe. In a typical financial crisis, investors move their money into a safe haven. When stocks become too risky, they buy U.S. government bonds, which are considered the safest assets in the world. For the first 2 days of the crash, that rule held. High demand for bonds pushed yields down, and the Trump administration cited those falling interest rates as proof that their policy was reducing the cost of borrowing. That stability was short-lived. In a break from historical norms, the bond market suddenly began a deep sell-off alongside the stock market. This simultaneous crash signaled a loss of confidence in the foundational assets of global finance. If the safe haven is on fire, the entire international financial architecture is at risk of collapse. To understand why this matters, you have to understand the Treasury bond itself. It is an IOU issued by the American government to pay for things like infrastructure and the military. When investors stop wanting bonds and start selling them, the market price drops. Because the government's payout is fixed, a falling price forces the bond's yield to move in the opposite direction. It spikes. On April 9th, these metrics reached extreme levels. The 10-year yield hit 4.5%, while the 30-year yield saw a jump of 54 basis points, the largest three-day increase since 1982. These yields dictate the cost of money for everyone. When Treasury yields spike, banks raise interest rates on mortgages, on auto loans, and on credit cards. The bond crash was no longer just a financial data point. It was becoming a mechanical trap that threatened to freeze the domestic economy. Investors were looking at the administration's policy and deciding that U.S. government debt was no longer a secure place to store wealth. This is a rare emergence of bond vigilantes, traders who punish a government for what they perceive as reckless fiscal policy by dumping its debt until that policy is changed. Traders feared that universal tariffs would spark high inflation. Since inflation erodes the value of fixed-return investments, holding U.S. debt suddenly became a losing strategy. International trust began to evaporate. Foreign governments, holding 1/3 of all U.S. treasuries, stopped buying and moved capital into gold and the Swiss franc. It was a moment where the collective decision-making of the free market effectively vetoed the economic agenda of the White House. On the morning of April 9th, while Glumpy central banks held emergency meetings, Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick arrived at the White House for an urgent meeting with the president. They delivered a blunt warning. If the tariffs were not paused, the revolt in the bond market would lead to an immediate and catastrophic borrowing crisis for the United States government. Faced with a total market meltdown, the president backed down. He announced a pause on the new tariff increases via a post on Truth Social. The timing of the announcement triggered a political firestorm. Just hours before the pause was made public, causing markets to soar, the president had posted that it was a great time to buy. Lawmakers immediately launched investigations into potential insider trading. The administration's aggressive rhetoric from just 1 week prior had been replaced by a rapid, total surrender to the realities of global finance. In the stock market, the reaction was immediate. Relieved investors sent the S&P 500 and the Nasdaq into historic one-day rallies. But the bond market was not as quick to forgive. Even after the tariffs were paused, yields remained high, holding near 4.6%. Broken trust is not easily repaired. Once global investors lose faith in a nation's fiscal stability due to a sudden policy shock, a single social media post isn't enough to bring them back. The crisis of 2025 clarified the hierarchy of global influence. A president can rewrite the rules of trade, but they are still subject to the ultimate authority of the bond market.